welcome to another edition of Money Matters TV. My name is Dan White. I am the host of your show. I'm also the president, CEO, and founder of Daniel A. White and Associates. We are a local retirement planning firm. We're headquartered in Glen Mills, Pennsylvania, but we also have two satellite offices, one down in Middletown, Delaware, and one a little further south down in Lewis, Delaware. And we work primarily with people that are retired or contemplating retirement. We craft income plans. We give Social Security advice, tax efficient distribution strategies. I mean, it's really how we navigate that last leg of your life when you're done working and you have to rely on your assets for income. And the big question that I've been getting, it's a routine question, but it happens all the time, is, hey, what's going to happen with the markets? What's going to happen? We're at all-time highs and this type of thing. And what's the Fed going to do? These are all common questions our clients give us. And it's kind of good news, bad news. I mean, it's the Fed lowered rates a month ago, but all the signs kind of point to the same thing, that and we've been calling for this for probably 2 years. But it looks like we're headed for a recession, right? Recessions typically begin after the Fed starts to cut interest rates. That's what's happened before the last 4 recessions going back to 1990. And we're seeing all the signs that would lead to a recession. Credit card debt is at an all-time high. It's still rising. The average interest rate on credit cards is now over 20%. This interest burden is suffocating many Americans. More and more folks are falling behind on their credit card and car loan payments. Delinquency rates are soaring. About 67% of the workforce is living paycheck to paycheck today. That's up from 63% last year. That's on the personal side. And it's kind of just as bad for corporate America. The cost of borrowing has risen sharply since 2021. It's killing companies with high debt loads. In July, 71 U.S. companies went bankrupt, according to S&P Global, and the number of bankruptcies is accelerating. That's up from 66 in June. And as of the end of July, 446 companies have gone under, the highest total for a 7-month period since 2010. Tail end of the Great Recession. So we may already be in the early stages of a recession. They kind of define a recession as 2 consecutive quarters of a shrinking economy based on GDP. And on an annual basis, the U.S. economy shrank 0.5% in the first quarter, but grew 3.8% in the second quarter. But those numbers are kind of skewed by President Trump's tariffs, which caused businesses to ramp up imports in the first quarter and slash them in the second quarter. Without those large swings in imports, our economy would have grown in the first quarter and shrunk in the second quarter. And remember, most of President Trump's tariffs just went into effect, so we haven't even seen the full effects yet. Tariffs are a tax on consumers and will only slow the economy further. And then inflation's still going in the wrong direction. But all that being said, the Fed is cutting rates. Inflation's going up. They ought to be raising rates, but they're more worried about the job market than they are about inflation. So they're going to cut rates. And a lot of people think, if the economy is growing, and again, the government's on shutdown, so we don't even get government figures these days, but they're cutting rates. A lot of people are predicting maybe a melt up in the stock market where, hey, we kind of go parabolic, then it goes up for 6 months to 12 months, and we have a top off. We have a market meltdown. We have a melt up, and then we have a meltdown. So it's hard to say what's going to happen. I mean, I don't think it's time to go all in on the stock market, and I don't think it's time to get all out. I think we just muddle through. And, the market, it's funny. It's kind of like it's not paying any attention to what's going on in the world because, we dropped a bomb on Iran about 3 months ago, and the market went up. And then we had the assassination, the poor assassination of Charlie Kirk. The market went up. And now we're on a government shutdown, and the market is continuing to go up until last Friday. We always wondered, what would be the thing that would tip the iceberg over. And then Trump came out Friday and imposed another 100% tariff on China, and the market did not react good. It fell between 2 and 3%, depending upon the index you look at. But then this week, it starts coming back up. So it climbs that wall of worry. Who knows what's going to be the thing that topples it? We just don't know. But like I said, I don't think it's time to get all out. I don't think it's time to get all in. I think you mind your asset allocation, your diversification, and you ride it out for the time being, because there's nothing really on the horizon that's going to topple the iceberg. So that's kind of our market update. We're going to move on now, and we do have a question from one of our guests, Nancy Morris from Boston. Says, just talked about this a little bit, Nancy, but how do you see stock market trends in the future, and especially small cap stocks? Well, again, what I just said was, if the Fed is cutting rates, that's not only good for the stock market, it's especially good for small cap stocks, because small cap stocks generally need financing. These are companies that are relatively small, and they need venture capital. They need financing. And if interest rates are going to be going lower, that bodes well for small cap stocks. So I see them doing well if the interest rates continue to come down, and obviously the stock market as well. But my concern is, again, valuations are sky high. We're looking at, you look at all the metrics to value the stock market, and we have only been higher maybe during the dot-com bubble. You look at all the metrics, and a lot of them say we're at the highest valuations we've ever seen. So usually the returns going forward from this point are not good. But that being said, we're cutting rates, and as I said earlier, we might have a melt up, but sooner or later, there's got to be a correction, a reversion to the mean, if you will, and stocks, unfortunately, will correct. So if you have questions to ask us on Money Matters, here's how you can do it.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says, Send us your questions. While you're on our website, you can find information about our host and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, MONEY, -matters, MATTERS, TV.com.
And I also want to announce, I'm very pleased to announce we have a guest on the program today. Our guest on the program today is Scott Hefty from SERAE Wealth. Welcome to the program, Scott.
Happy to be here, Dan.
Yeah, so, Scott, before we get into the questions that I know you wanted to cover today, why don't you tell us a little bit about your firm and kind of what you do?
Yeah, great question. So firm name is SERAE Wealth. We're based out of the Woodlands, Texas. Really focused on, a values-based approach, working with people who not only want to worry about, financial concerns of today, but really expanding their legacy, for their families and having that community impact. So working with people who are navigating transitions, whether it's retirement planning or inheritances, high income earners, and really hoping to instill a value set to their money and make sure that all of their financial pieces in life are pulling in the same direction. That's really our focus and the people we work with on a day-to-day basis.
Yeah, it's interesting. I'm a CHFC myself, so we share common designations from the American College. So we kind of do similar types of things. And you probably heard my monologue where, hey, where's this thing going? We just don't know. But one of the variables that we had this year, which was an unknown coming into the year, was, with the new president and all, is what's going to happen with tax rates, because the tax cuts were due to sunset. And then they passed the big, beautiful bill. And one of the things in the big, beautiful bill that hasn't got a lot of press yet is these Trump accounts. I love it. We have the Roth IRAs, and now we have the Trump accounts. And can you start by explaining what these new Trump accounts are and how they work for families with newborns?
Absolutely. There's a new account in the mix now. And so that is a great point. You mentioned the Roth IRAs and how they were introduced in 1998. We now have a new player in the field, and it's going to be these Trump accounts. And really, I think they're going to change the way that we do financial planning, especially for families who are really legacy and generationally focused. High level, starting next year, newborns born between January of 2025 all the way till December 2028 are going to automatically be getting $1,000 contribution from the U.S. government into these Trump accounts. And so this is going to provide families with the opportunity for early access to markets, especially on a tax advantage basis. So these accounts are going to be tax deferred. And families can also contribute funds on top of that moving forward, up to $5,000 a year currently. So, Dan, when we look at this, we know that most of our wealth growth occurs towards the end of our lives as that compounding really starts to take hold. This is going to afford families and children as they grow up to begin that compounding of wealth at an earlier age. Most other retirement accounts are we have to have earned income to make those contributions. And this account doesn't have earned income restrictions. So, from a very early age, we're going to be able to see families fund these and have that wealth building snowball occur from very young ages.
Yeah, well, they say compound interest is the eighth wonder of the world, so you got to make it work for you. It's interesting. I guess I had my kids about 30 years too early, unfortunately.
Yeah.
So we're not going to get Trump accounts. But your firm estimates, it's interesting. I could talk about an Ed Slott thing I came across, but your firm estimates the initial $1,000 deposit could grow to nearly $500,000 by retirement. What assumptions go into that calculation, and how realistic do you think that projection is?
I think it's really realistic. And now, obviously, Dan, as we look at this, sequence of returns matter. Timing the market could change these numbers a little bit. But, when we looked at these numbers, if this money stays invested at just a 10% rate, which, even the White House's own Council of Economic Advisors gives that as their middle case as a 10% compounding rate, that $1,000 all the way till age 65 gets to be around that $500,000 number. And it sounds hard to believe in some ways, but that extra nearly 20 years of compounding growth really starts to snowball. And as we're looking at retirement planning for the future for, our children and grandchildren, right, that extra years of growth is really going to make an astounding impact. It truly has a chance to change the way that this retirement equation will develop for future generations.
Yeah, I think it's an incredible thing. And the growth potential jumps dramatically from 490,000 to 22 million if families max out the contributions they're allowed to make. Can you walk us through what it would take for a family to achieve that $22 million number?
Yeah, no, great question. And so currently, as the bill is written, families will have the opportunity to contribute $5,000 annually on top of that initial $1,000 in seed money. So we just took a pretty easy equation. We said, what if a family were to contribute $5,000 a year up until age 18? That is the maximum point which you can contribute. So after that, you can't add more money. But then if the child or family were to leave that account alone all the way to age 65, at that 10% annual compounding rate, you get around $22 million. Now, these, again, the market timing and sequence of returns, those all matter here. But I think really the story with this is the potential impact it can have. Now, these funds need to be invested in the U.S. market, usually in very low-cost funds. These are restrictions written into the bill. And so I think the story in general is how great of an impact this potentially can have. Whether it reaches higher than 22 million or lower, I think is a moot point when we look at this, because I think we can easily see the impact.
Oh, absolutely. Can you talk a little bit, Scott, about the potential generational impact that could have for families looking to transfer wealth down the line to children and grandchildren as part of their gifting and legacy strategy?
Yeah, no, a lot of the families we work with here at SERAE Wealth are really concerned about the impact they leave, both the values they imprint and also taking what they've accumulated and built and distributing it to their family members or their communities. And so this becomes a tremendous generational transfer tool. The ability for parents or grandparents to take that $5,000 a contribution amount and start setting this into accounts for their children and grandchildren, having that compound interest accumulate on a tax deferred basis. So many families we meet with are worried about, should we establish trust accounts or college saving 529 plans? This new account entering the scene the way it has is going to be a really impactful tool for families who have that wealth currently, and they're looking to make that transition down the line to future generations. And that compounding that they're going to get, that tax advantaged compounding for those children, is going to play a significant impact.
Yeah, people don't realize the tax and the compound interest. It just is phenomenal. And you mentioned it up to 2,500 of the annual contribution can come from employers. How do you see this changing the employee benefit landscape, and what should companies be considering?
Yeah, that's a very interesting carve out, right? And that's written specifically in the language of the bill. And, our senior partner here, my senior partner, Joe Anderson, I think he just did an op-ed in CEO World on this topic. I think this is going to be in an industry that's competing for high skilled talent, right? This is going to be an employee benefit that I expect a lot of companies to take advantage of as a way to entice and retain employees. That extra if 50% of that account funding for your children or grandchildren can come from your employer, I don't see why families and companies wouldn't jump on that opportunity as that benefit from the beginning. It seems like a no-brainer to me.
Yeah, it really does. And this next question, it's kind of interesting, and I wanted to delve into this a little bit. So there are restrictions, obviously, on when the money can be withdrawn, primarily after age 59 and a half, but there are some exceptions for education, home buying, starting a business. How does this structure compare to other savings vehicles that families might already be using?
Yeah, great question. My father's a CPA in Ohio, back where I grew up. And one of the things he always told me from a very early age is that the tax code isn't just about revenue for the government, it's about an incentive structure. And so when you look at the rules for these accounts, it's pretty clear they're set up as retirement accounts. I mean, that's the purpose from the beginning. Yes, there are exceptions where we can take withdrawals for, home purchases, like you were saying, education expense. There's some adoption and medical, but there's some exclusions for that. But it's pretty clear to me that the intent of this is to have this money invested early on, compounding for the next 60 or 70 years of a child's life, and then have those withdrawals coming out in retirement. That's the structuring of this. Now, there are those different parachutes that I like to say that allow some flexibility. And some people would prefer a little bit greater flexibility, but I always want to remind people the things we are given usually have some strings attached. And I think if we use those the account's abilities to our advantage and work within the guidelines of that, it's still going to make a really significant impact in the long run.
Well, flesh that out a little bit further for me, Scott. So you're saying the families can contribute $5,000. Is there any tax deduction on the contribution?
Yeah, there's no tax deduction on the contribution. That's a great question. So, and to be honest with you, this bill is so new, we're still waiting on some clarification that will likely come out here as the IRS and the Treasury determines how best to implement this law. What a lot of people don't realize, Dan, I'm sure you and we know, Congress will pass a bill, and then it becomes on regulators to determine how the actual rule set will come about. But when we look at this, it doesn't seem like contributions are going to be tax deducted. So that's expected. And let's say an employer does that $2,500 contribution on behalf of their employees, I would expect that to be a taxable benefit. But once in that account, there is no capital gains tax. We're not going to pay any tax on dividends or interest. And there will be no tax impact until withdrawing that money out. And that withdrawal will occur from either being one of those qualified events we talked about, so educational expense, business, whatever it may be, or if they wait till 59 and a half, then there will be no penalty, but there'll be regular income taxes owed on this. So think of it really functioning similar to a 401k or an IRA account. That's really the best comparison we have for the after-tax withdrawal effect on these accounts.
Okay, so if I'm hearing you correctly, then it is ordinary income when it does come out. So it grows tax deferred while in the account. You're not getting any, it's kind of a combination because you're not getting a tax deduction similar to a Roth. Okay, grows tax deferred. Now, when you take it out, let's say you did make the contributions to $5,000 a year. That's after tax money that went in. How are they going to carve that out?
Yeah, and that's really going back to there's going to be the IRS is going to have some figuring here. And
Yeah.
lay out exactly the rules for how these withdrawals are going to be taxed is going to be an interesting question. But to what we understand now, there's no tax deduction for those contributions. And to be honest, I would be surprised if they ever added that. Dan, one of the things I always remind people when it comes to these laws and these tax regulations is they are written in pencil. Just like I said, in 1998, right, the Tax Efficiency Act or whatever it may be that introduced Roth IRAs originally, there's been continuations to changing and evolution over time. So I would expect that to continue with these Trump accounts. But in today's version, there's really no tax deduction for those contributions. But to be honest with you, Dan, that's not really my concern when I'm looking at this. I think even withstanding that and understanding that kind of caveat, the impact of that building over time and without having that leaking tax liability ongoing, I think it's such a huge advantage that even if it's not tax deductible for the contribution, I mean, many people are going to need to look at this.
So we're going off chart a little bit here, but compare that to people that we're running into, and this as well as I do. They build up a lot of money in tax qualified accounts. It becomes a tax torpedo, and now you got RMDs and and you'll be in a lower tax bracket. That's not the case because they built up so much money in these. Do you think there will ever be any type of vehicle where they could do a conversion of some sort to make it tax free?
I like the way you're thinking because these are the types of questions I think about too. What's the long-term implication here? What's the?
I mean, $22 million sounds great, but if it's all taxable,
yeah. There's a lot of things are going to have to unfold over time. What I will say is, especially as we're looking at how all these pieces come together, if an individual has this Trump account that is accumulating wealth, how we plan our financial situation with the other aspects around it to help counterbalance that is going to be really important. How do these tools fit together as part of a cohesive plan? And families that understand that, I mean, Dan, we see this too when the 401k and IRA accounts came about when they were first introduced. Families that leverage those tools and look to understand that and build it as part of a cohesive plan, they really reap the benefits of this. And so if families will do the same thing with these Trump accounts, understand the rule set, work with an expert who can help guide them through this, making sure we have all these other pieces line up with the great points you mentioned here about the downsides of this, that's going to be a real key as we're navigating this new landscape.
Yeah, it's interesting because one of the things here is what if they can't afford the $5,000 annually? To me, it looks like, hey, it's a great, grandparents. You want to set up 529 plans and this kind of thing. This sounds a lot simpler. Hey, as long as you can take it out for education, the grandparent could contribute to $5,000. That's within the gifting limits. So what do you see along those lines?
100%, right? I do expect some parents to set these up for their children, but really I see this as a grandparent tool setting up for their grandchildren, right?
Yeah.
There are many grandparents that we meet that have built quite a nest egg. They're looking to expand their impact generationally and are trying to find the right tools to do it. We're talking about, do we use trust accounts or UTMA accounts or 529? And suddenly this new account comes into play here that I agree with you, Dan. It's pretty straightforward. In a lot of ways, this becomes a very simple way to make a generational impact. And like we were saying, we see the numbers over time. I can't think of a better tool to really build that generational wealth for families.
I mean, I can actually see like a comparison chart coming out between a Roth IRA, a 529 plan, and a Trump account. Like, what are the advantages of each of them? What are the disadvantages? And then people could kind of determine, how to best allocate their dollars.
Yeah, and you're bringing up a Roth IRA, right? I mean, I'm obviously a Roth fan in a lot of ways. It becomes a great tax planning tool. But we know the challenges of getting money into those Roth IRAs for many children. And, there's certain earned income requirements. There's ways to get around that. But suddenly these Trump accounts don't have that earned income. For a 1, a 2, a 3-year-old, I can make these contributions. And they're not limited to education expenses like maybe a 529 plan is.
Right.
I mean, there's a lot of really positive benefits to this.
Yeah, you got to look at it because a lot of times, people look at the 529 and say, well, And now the Secure Act 2.0 actually allows you to roll that into a Roth, that kind of thing. So yeah, the landscape is really changing when it comes to saving money. Some critics might argue the government could provide more flexibility and fewer restrictions. How do you respond to concerns about, the restrictions and the requirements they put on these accounts?
Yeah, I always go back to that wisdom my father told me, which is the tax code isn't just about revenue for the government, it's about incentives. And so where they gave us a lot of flexibility and a lot of ability to compound and grow our wealth, they put some restrictions on it. Make no mistake about it, right? There are some carve outs to where we can make penalty-free withdrawals from these Trump accounts in certain circumstances, but it's pretty clear the intent is for this money to be left all the way till retirement age. And so that's the bargain we're signing up for. Would I love greater freedom? Absolutely, we all would, but really, this is the type of give and take I would expect when we're introducing a new account in this way.
It's kind of interesting that the more I think about it, I haven't really looked at these Trump accounts too closely yet, but the more I think about it, it's hard. You can't put money in a retirement account for a child, unless they have earned income. So, unless a child's like 12 years old cutting grass, or you're paying them to take out the trash or something like that, you can't put money in an IRA. You can't put money in a Roth IRA. So I guess it is really a method of getting newborns at this point to put money away for retirement before they even know what money is.
Yeah, no, I mean, when we think about the retirement planning system, the way that even government entitlement programs work, where Social Security, where this is an opportunity to go away from that defined benefit approach to one where now we're getting money into these accounts earlier, 20 years earlier than really most people could ever get it into before, right? Usually that first job at 18. And that extra almost 2 decades of growth is it's such an incredible advantage. And I think we're going to see that play out. This generation that's going to have these Trump accounts is going to have such a wonderful leg up compared to past. And it's going to be something that I think in our space as wealth managers, like we do every day, it's going to be a significant part of an overall financial plan.
Yeah, the only concern I have, and this just popped up while we were talking about this, is again, you're in the same boat as I am, Scott, and what we deal with, because we deal with people 50, 60 and older, is this tax torpedo, that we did get brainwashed. Hey, start maxing out your 401k. And now they're 65 years old and they got, several $1 million, but it's all taxable, right?
Yeah.
So it's like they're getting hit in higher brackets and they're getting IRMA charges on their Medicare premiums. And it's like, gosh, we didn't see this coming. Well, I see this even being worse because now you got 20 extra years to compound that money.
I mean, I would expect these account rules to evolve. I mean, as it's written right now, pretty much the only investment choices are the S&P 500, and there's no bond allocations. So, I mean, I think that along with this tax planning aspect will certainly come over time, just because even the investment piece of this, I don't think it's going to be suitable for people once they reach the, age 50 and 60. So there'll be some expansion to this.
Yeah, there always is. Like you say, they write the tax code in pencil and, they change it. I mean, look at what happened in the last 5 years between the Secure Act 2.0. It's kind of crazy. So,
absolutely.
Well, Scott, I want to thank you for being on the program today. It was, I learned a lot. It's very interesting. The Trump accounts are here and who knows how long they'll be here, but I really appreciate you being on the show today.
Thank you for having me.
Yeah, and our next guest on our next program of Money Matters is going to be Vihan Janjigian. He's the CFA and Chief Investment Officer of Greenwich Wealth Management. So I want to thank everybody for joining us today on Money Matters, and we'll see you next time on Money Matters TV. Have a great week.